Welcome to Commerce and Management Solutions. In this video, we are going to work out one question on future or present value of annuity due. So you have to understand what is annuity due before taking the question. So let me explain that. In case of normal annuity, we will make the payments. In case of normal annuity, we will make the payments at the end of the year. End of the year, we will make the payments. That is called as normal annuity. But in case of due, annuity due, we will make the payments at the beginning of the period. We will make the payment at the beginning of the period. That is called as annuity due. Let us take an example. A person has to make the payment 2000 every year. This he can make in two ways. There are 4 years you have to make the payment. Just take an example. 2000 rupees you have to make for 4 years. This person can make this 2000 payment in two ways. One is at the end of the year. One is at the beginning of the period. Let us take here 0, it is a starting. So 0, 1, then 2, then 3, then 4. There are 4 years. If he is making at the end of the first year, means he is making the payment here 2000. Then say like if he is making the payment here at the end of the second year. So here it is 2000. If he is making at the payment at the end of the third year, if he is making at the end of the fourth year, the payment is 2000 at the end of the fourth year. This will be called as normal annuity. This is called as normal annuity. But if he is making the payment at the beginning of the first year, means here it is 2000. If he is making the payment at the beginning of the second year, 2000. If he is making the payments at the beginning of the third year, it's 2000. If he is making the payment at the beginning of the fourth year, this will be called as annuity due. That is the difference between annuity, normal annuity and annuity due. Hope you understood that, right? Annuity due means in the beginning, annuity, normal annuity in the case means at the end of the period. That is the difference between normal annuity and annuity due. So let us take a question here. Mr. Alex invested $6,000 for 5 years at the rate of 8% on an annuity due. 8% on an annuity due basis. Calculate the value of the investment. Here, investment he is making 6,000 at the rate of 8%. This is on annuity due basis, means beginning of the period he will make the payments. To work out this question, we can use a simple formula. PV divided by R into 1 plus R is n minus 1. This part of the equation we already discussed in the previous question to calculate the future value. If in case of normal annuity, we can use only this part of the equation. This part of the equation is addition in case of normal annuity due. Here it is 1 plus R has to be multiplied with the normal annuity. That is only the difference. So just study this formula, that is PV divided by R into 1 plus R is n minus 1 into 1 plus R. So let us take the values. Here PV we need, that means the present value. Present value is given in the question, that is $6,000, right? Then next R we need, R is given in the question, that is 8%, so means 8 divided by 100 is equal to 0.08. Then n is given in the question, that is 5 years. Just apply these all values in the formula, then you will be getting 6,000 divided by 0.08 into 1 plus 0.08 raise 5 minus 1 whole brackets into 1 plus 0.08. Then you will be getting here 75,000 into 1.08 raise 5 minus 1 into 1.08. Then it is 75,000 into 1.08 raise 5 is equal to 1.469 minus 1 into 1.08. So here 75,000 into 0.469. So here 1.469 minus 1 is equal to 0.469 into 1.08. Then finally you will be getting the value, that is 75,000 into 0.507, that is equal to 37,989 he will be getting. 37,989 he will be getting if he is investing $6,000 every year for 5 years at the rate of 8% on annuity due basis. He will be getting 37,989. Hope you understood how to calculate the future value in case of annuity due. Just remember that formula, then apply the value into the formula, then you will be getting very easily the answer. Let us take another question. Mr. Shan invested $8,000 for 5 years at the rate of 8% on annuity due basis. Calculate the present value of the investment. In the previous question, we worked out future value. Here we will calculate the present value. How to calculate the present value? We have a formula here. That is P divided by R into 1 minus 1 plus R raised minus 1 into 1 plus R. Apply this formula if you are getting this kind of questions to get the answer. Then find out the values which are required to work out this formula. So here P value, we want the P value, that means the present value or the principal amount, that is 8,000. Principal amount is 8,000, not principal, present value, because it is an annuity. Every year he will make the payment, right? Then R is equal to 8%, means 8 divided by 100 is equal to 0.08. Then N is equal to number of years is 5. Apply this all information, all values in the formula, then you will get the answer. That means 8,000 divided by 0.08 into 1 minus 1 plus 0.08 all power minus 5 into 1 plus 0.08. Then you will be getting here 8,000 divided by 0.08 into 1 minus 1.08 raise minus 5 into 1.08, which means here 8,000 divided by 0.08 is equal to 1 lakh into 1 minus 1.08 raise minus 5 is equal to 1.08 raise minus 5 is equal to 1 divided by 1.08 raise 5, that is equal to 1 divided by 1.469. So the answer is 0.681, that is 1.08 raise minus 5. So here we can write 1 lakh into 1 minus 0.681 into 1.08. Then you will be getting here 1 lakh into 0.319 into 1.08. So that is equal to 1 lakh into 0.345. So the answer is equal to $34,500. So he will be getting $34,500. That is a present value of the amount which is going to get After 5 years, if he is making payment 8,000, there is a present value of that amount. That will be in the future, it may be higher. So here the present value is only 34,500 he is getting right now. So this is the way we can calculate the present value or future value in case of annuity due. Let us take a question here. A company buys a machine for rupees 1 lakh. Its estimated life is 12 years and its scrap value is rupees 5,000. What amount is to be retained every year from profits and allowed to accumulate at 5% compounded interest per annum for buying a new machine at the same price after 12 years? So the price after 12 years should be the same. So the cost of machine we can take it as 1 lakh. Cost of machine is equal to 1 lakh. We will take cost of machine is 1 lakh. In here, scrap value we can deduct scrap value 5,000. So the amount will be 95,000. Means after 12 years, at the end of the 12th year, the company must have 95,000 rupees in their account to buy a new machine. So the future value is 95,000. We can say this as the future value. Future value is 95,000. To get the future value of 95,000, how much amount they have to retain every year from their profits? That we need to calculate that. Let's take it as P. That is called as P. Then N is given here, that is 12 years. And also interest rate also given, that is how much is interest rate? 5% per annum. Means 5 divided by 100, so that is equal to 0.05. So now we have all the information to calculate future value. We know how to calculate future value. This is not in the case of annuity due. Here nothing has been mentioned whether it is annuity due or normal annuity, so we can take it as normal annuity. If it is not mentioned, it is annuity due. In such cases, we can consider it as normal annuity. In case of normal annuity, we know how to calculate the future value. Future value is equal to P divided by R into 1 plus R raised n minus 1. This is the formula to calculate the future value. Here future value has been already given, calculated, that is 95,000. N is given, R is given. By using this information, we need to calculate the P value. So we can take here future value, that is 95,000 is equal to P divided by 0.05 into 1 plus 0.05 raise n is 12. So we will take n is 12 minus 1. So 95,000 is equal to P divided by 0.5, P divided by 0.05 into 1 plus 0.05 raised 12 is equal to 1.797 minus 1. So that we can write again here 95,000 is equal to P divided by 0.05 into 0.797. Mathematically, we can work out this. That is, P we can take it out. So P is equal to 95,000 into 0.05 divided by 0.797. Then you will be getting answer is 5,959.85 rupees they have to maintain every month to get the 95,000 profits at the end of the 12 years. So now we got answer how much amount has to be retained, that is 5,959.85 rupees. We will write it as 5,960 rupees. 5,960 rupees they need to maintain every year from their profits. Then they will be getting around 95,000 at the end of the period. Then you can add that scrap value at the last, that is 5,000. So your total amount will be 1 lakh. Hope you understood how to calculate the future value and how to apply this future value and present value formula to get this kind of question answer. So please work out this question to get more clarity and you will get the answer. Please give your answer in the comment box. Thank you so much for watching the video. Hope you understood everything.